What if I told you that a storage company delivered a return of more than 2,000% in about a year after relisting? Headquartered in Milpitas, California, SanDisk, with the ticker SNDK, is one of the most fascinating stocks in the market right now. The company has surged on the back of the AI infrastructure boom, NAND flash shortages, aggressive price increases, and explosive earnings growth. Revenue is up 61% year over year. Earnings per share jumped to $6.2, almost double what analysts were expecting at around $3.31. Gross margin expanded from 32.5% last year to 51.1% this year, and the company now commands a market capitalization of $100 billion. So the big question is this: after such a massive rally, is SanDisk still a buy? Or are investors now standing near the top of a classic memory cycle where one day the music stops and valuations correct sharply? In this video, we will break down SanDisk's stock performance, its operations, its financials, what analysts and major shareholders are saying, the risks, the opportunities, and finally, whether this is just a momentum trade or something that can truly compound over the long run. Stock performance. SanDisk has been one of the biggest beneficiaries of the AI infrastructure boom. Demand for artificial intelligence systems has pushed the need for memory and storage to extreme levels, and that has created an unprecedented supply shortage in NAND flash memory. As a result, prices have reportedly tripled in the past year, and SanDisk has ridden that wave very aggressively. There is also speculation about a possible stock split. As the share price has moved above $700, some investors believe management may eventually consider a split. The logic is simple. A very high share price can make the stock feel less accessible to some retail investors, and it can also concentrate trading activity among larger holders. A stock split would not change the underlying value of the business, of course, but it could improve overall liquidity, make the stock psychologically more approachable, and potentially create a more active options market. SanDisk's history is a little unusual, which makes long-term return analysis more difficult than normal. The company was originally formed in 1990 and got listed in 1995. Then, in 2016, it was acquired by Western Digital and was no longer separately listed. After that, it re-emerged through a spin-off from Western Digital in February 2025 and got listed again. Because SanDisk has not been relisted for very long, chart analysis is limited, and the early trading period has been highly volatile. At the time of relisting in February 2025, the stock started at around $36. Up until August 2025, returns were fairly nominal. Then, from September, the real takeoff began. The stock kept climbing and eventually reached a peak of around $778 per share in March 2026. That means from the relisting price to the peak, SanDisk delivered roughly a 2,061% return in about a year. That is an extraordinary move. Since then, the stock has started to cool off and is now trading around $683, which is about a 12% drop from its peak. That pullback may not sound huge after such a dramatic rally, but psychologically it matters. It suggests that the market may be entering a new phase, not necessarily a collapse, but perhaps a phase where investors begin asking harder questions about sustainability. For context, during its earlier listed life between 1996 and 2016, the company delivered about 458% total return over 10 years. That is still a strong outcome, but again, it may not be fully relevant to today's world because the structure of the storage market, the role of AI, and investor expectations are all very different now. SanDisk does not pay a dividend, and honestly, that makes sense at this stage. This is not the kind of company investors buy for dividend income right now. It is a company still tied to a large capital expenditure environment. Let's also talk about some of the key ratios. SanDisk's ROAS is 41%, which is a very strong number and suggests the company is generating substantial returns on the capital employed in the business. At the same time, this is not a low volatility stock. The company's beta is 2.4, which tells you the stock is aggressive and volatile. In April 2025, SanDisk dropped 40%. If there is news that supply is expected to normalize, or if the company misses quarterly targets, the stock price could react very badly. This is not a stock for people who panic easily. Now, this part is especially interesting because the message from the market is mixed. On one side, you have legendary investor Stanley Druckenmiller, who ran Duquesne Capital between 1981 and 2010, and reportedly earned an average return of 30% annually without a single down year. He has sold his entire position in SanDisk stock. That does not automatically mean the stock is finished. But when someone with that kind of track record exits, investors notice. Then there is the short side. Citron Research announced that they will short SanDisk. But of course, Citron has previously shorted Nvidia and Tesla and suffered losses on both, so investors may not automatically take that call as decisive. On the other side, there are still buyers stepping in. Waypoint Wealth Counsel established a new position, purchasing 1,632 shares valued at roughly $387,400. Cromwell Holdings LLC increased its stake by around 38%. Meanwhile, Citi lifted its price target on SanDisk to $875 and reaffirmed a buy rating. And one research source noted that out of 21 analysts covering SNDK, 14 recommended strong buy, 1 recommended moderate buy, and 6 recommended hold. So what is the message here? The message is that analysts overall still seem positive on SanDisk, at least in the short run. But the presence of high-profile selling and short interest tells you that the debate is becoming sharper. Looking at the shareholder base, SanDisk is largely institutionally owned. Fidelity holds 14.5%, Vanguard holds 11.5%, BlackRock holds 6.5%. At a broader level, mutual funds and ETFs hold 39% of the company's shares, other institutional investors hold 48%, and the remaining 13% is held by public companies and retail investors. This matters because when institutions dominate ownership, short-term volatility can still be intense, but the stock may eventually find more stable footing once the excitement and fear settle down. Another question many investors have is insider selling. There has been insider selling, but the size and context matter. Director Necip Sayiner sold 1,200 shares. Another director, Miyuki Suzuki, sold 3,500 shares. Chairman and CEO David Guckler sold around 4,000 shares. These sales occurred between December and February 2026. Now, on paper, insider selling can sound alarming, but in this case, the key argument is that these sales were mostly tax-related, and these individuals still hold a significant portion of their SanDisk shares. This is where things get really interesting, because SanDisk's valuation depends heavily on which framework you trust. Simply Wall Street says SanDisk is trading at 67% below its fair value, estimating fair value at around $2,000 per share. Morningstar estimates fair value at $670, which would imply that the stock is roughly fairly valued. That is an enormous spread. So what does that tell us? It tells us that SanDisk is the kind of stock where valuation models can produce wildly different answers depending on the assumptions you use about future margins, pricing, cyclicality, and how long this AI-driven storage boom can last. So yes, the stock could still have short-term upward potential, perhaps even toward $1,000, which is around a 50% gain from its current levels. But whether that happens depends on one crucial issue: how long can current profits remain elevated? If you're getting some value from this analysis so far, do consider joining the channel. It really helps support this kind of work and encourages me to keep making detailed videos like this. Now let's talk about one of the most important long-term questions. Does SanDisk have a moat? According to Morningstar analyst William Kerwin, SanDisk does not hold an economic moat. Guru Focus shows SanDisk with a moat score of 6 out of 10. That does not mean the company is unimportant. It clearly is important, but it suggests that its competitive position may not be strong enough to guarantee excess returns for decades in the way that truly great compounders often do. And that distinction is very important for investors deciding whether this is a trade or an investment. Let's now move into the operations side, because this is where the SanDisk story becomes much easier to understand. Most people think AI is only about GPUs, the brains doing the thinking. And to an extent, that is true. GPUs are the computation engines. They do the heavy mathematical work. But AI also needs storage. In many ways, storage is like the giant library behind the system, the place where data, model files, and information are kept, moved, and retrieved. And that is where SanDisk comes in. In the real world, tools like ChatGPT are not just sitting on one computer. They are massive systems constantly pulling, moving, and storing huge amounts of data. So when you think about AI infrastructure, there are really two core pieces: computing and storage. Computing is the thinking part, the actual process of calculating an answer. A simple way to explain this is with a basic example. If I ask, what is 23 plus 42? You actually have to do the math to get 65. But if I ask, what is 2 plus 3? You answer 5 almost instantly. It feels like you did not even calculate. Why? Because your brain has seen that combination so many times in real life that it feels almost stored, almost ready to be pulled up immediately. That familiarity saves effort and energy, and that is a useful way to think about AI systems at scale. GPUs do the heavy computation. That is the thinking. But the system also needs a massive memory shelf where data, model files, and information can be stored and retrieved extremely quickly. And that storage layer, the part that helps AI feel fast, responsive, and reliable, is where companies like SanDisk fit in. SanDisk storage shows up in three major places. First, data centers and cloud, which are basically the internet's warehouses. This is where the world's applications run. AI services, websites, streaming platforms, banking systems, and much more. Second, consumer devices, SSDs and laptops and desktops, memory cards, portable drives, and the everyday storage products where your personal photos, videos, and files live. Third, edge devices, meaning storage inside systems closer to where data is created rather than in giant centralized cloud facilities. This can include corporate servers, IT equipment, cameras, industrial systems, cars, medical devices, network gear, and telecom systems. So SanDisk is not just one narrow AI story. It actually touches several parts of the digital economy. SanDisk designs storage products based on NAND flash technology. That includes embedded drives for edge devices like personal computers, automotive systems, and gaming consoles, as well as solid-state drives for data centers. One of the company's major strategic advantages comes through its joint venture with the Japanese manufacturer Kioxia. This partnership helps SanDisk realize cost savings and supply chain security because the two share expenses related to fabrication equipment and memory design. And SanDisk's agreement with Kioxia is especially notable because it is tied to a 25-year contract, which gives the company a meaningful cost advantage on the manufacturing side. Flash Ventures operates across 8 flash-based manufacturing facilities in Japan. In addition, SanDisk also has assembly and testing operations in China through SDSS in Shanghai. That said, SanDisk is still the 5th largest supplier of NAND flash memory, and the company may not have anything uniquely differentiated enough to drive major market share gains from here. That is part of why the moat argument remains weak, even if the company is highly relevant. On the customer side, SanDisk does not seem to have long-term customer contracts in a broad sense yet, although it appears to be working toward multi-year agreements with data center customers, with deals potentially spanning from 1 year to 5 years. If those agreements become more common, that'd be one of the most important changes in the SanDisk story, because it could help protect margins across cycles and reduce some of the boom and bust dynamics that have historically kept a ceiling on NAND valuations. This is where investors need to stay grounded. The memory chip industry is notoriously cyclical. In past bust phases, companies in this space have seen their stocks fall by 80% to 90%. That is not a typo. History shows that when the memory cycle breaks, the damage can be brutal. Chimanda, a major memory maker spun off from Infineon, went bankrupt during the 2008-2009 crash, effectively wiping out equity holders. Elpida Memory, another major DRAM manufacturer, also collapsed and filed for bankruptcy in 2012 before eventually being acquired by Micron. Micron Technology, despite surviving and remaining one of the best-known memory players, has gone through repeated deep slumps, including an 80.6% decline from the end of 2006 to the end of 2008. SK Hynix, another major DRAM, NAND, and SSD company, fell by around 84.5% in 2008. Spansion lost an astonishing 98% of its value in 2009 before filing for bankruptcy. And even outside pure-play memory, Wolfspeed shows how brutal semiconductor downturns can be, with the stock reportedly falling roughly 93% from its late 2021 highs by September 2024. So the broader lesson is clear. In this part of the chip industry, when conditions turn, even well-known companies can see devastating declines. When supply is tight and pricing is strong, memory companies can look incredible. Revenue jumps, margins expand, earnings explode, and stocks suddenly seem cheap. But when supply catches up, prices fall, profits compress, and the same companies can look deeply unattractive very quickly. That is why profit-taking after strong runs has historically not been irrational in this sector. However, the industry may be a little different this time because companies are increasingly leaning toward long-term contracts, rather than relying only on short-term pricing exposure. If that shift continues, it could provide more stability than previous cycles. The good news for SanDisk is that because debt is low, the company may not be hit as badly as more leveraged peers when the cycle turns. And according to Morningstar, supply constraints are expected to endure until at least 2028, which would support the bullish case that this favorable environment may last longer than many investors think. Now let's move to the financials, because this is where the recent excitement around the stock becomes much easier to understand. Looking at the latest quarter report from January 2026, SanDisk has total assets of $13 billion. The largest component is goodwill of $5 billion. It is also reassuring to see that the company has around $1.5 billion in cash. Inventory stands at around $2 billion, which, considering the level of sales and margins, suggests supply of roughly 6 months. On the liability side, it is encouraging that there is very little debt. One interesting item is that the company still has an accumulated deficit of $869 million. But given the current level of profitability, that deficit could potentially turn into retained earnings over time if this earnings power continues. Now let's talk about operating performance. Revenue jumped from $1.8 billion to $3 billion, which is an increase of 61%. Not only did gross profit increase by around $1 billion, but gross margin also improved from 32% to 51%, showing that SanDisk is currently enjoying real pricing power. Net income increased by around $700 million, and net margin rose from 5.5% to 27%. That is a huge improvement. And importantly, these results came in above analyst expectations, which helped fuel the stock's upward surge. If we break revenue into segments, around 55% comes from Edge, 30% from consumer, and 15% from data center. Now, even though data center is the smallest segment at the moment, it is also the fastest growing, with revenue up 76%. Revenue from Edge increased by 63%, and consumer grew by 52%. That is very encouraging because it shows that growth is not isolated to just one part of the business. All major segments are growing at above 50%, which suggests this is a broad-based surge rather than just one lucky product line. Geographically, revenue is heavily concentrated in Asia, which contributes 68%. The Americas account for 17%, and EMEA contributes 15%. Customer concentration also looks manageable. The top 10 customers account for 44% of quarterly revenue, but no single customer is above 10%. That means there's no obvious single customer concentration risk, which is a healthy sign. Looking forward, the bullish case remains very powerful. AI and global data center infrastructure investments are expected to reach $7 trillion by 2030. That should help support NAND flash memory demand in the coming years. TrendForce anticipates NAND flash contract prices will jump between 55% and 60% in the first quarter of 2026. Analysts at Bank of America project a 45% revenue surge for the full year in the NAND business, supported by a 26% rise in average selling prices. SanDisk's own leadership has also issued ambitious guidance. For the upcoming third fiscal quarter, management forecasts revenue in the range of $4.4 to $4.8 billion. Adjusted EPS is expected to come in between $12 and $14, which would represent another substantial leap. Analysts also forecast SNDK's revenue to increase from $7.3 billion in 2025 to $27 billion in 2027. In addition, SanDisk remains focused on innovation, with 7,900 granted patents and 3,200 pending patents globally. In the same period, EPS is forecast to rise from around $3 to $87 per share. That is an enormous leap, and if even a large part of it materializes, it explains why many investors remain interested despite the stock's already massive run. That is what keeps the bull thesis alive. The key question is not whether business is strong right now. It clearly is. The key question is, how long can this AI-driven supercycle keep pricing elevated before new manufacturing capacity catches up? Because new capacity takes years to build, the supply picture may remain constrained for the next few years, and that is one of the strongest arguments for continued upside. At the same time, the broader industry backdrop also looks supportive. According to Fortune Business Insights, the global AI-powered storage market is projected to grow from $45 billion in 2026 to $271 billion by 2034, with a CAGR of 25%. So maybe the best way to think about SanDisk is this. In the short term, momentum may still carry it higher, especially if pricing stays tight, guidance keeps surprising to the upside, and the market continues rewarding AI infrastructure names. But in the long term, the stock looks much less certain. Not because storage is unimportant. In fact, storage is absolutely critical in the AI world, but because being important is not the same as having a durable moat. AI is here to stay. And as AI grows, companies like SanDisk will remain relevant, because intelligent systems do not just need to think, they also need to remember, retrieve, and move massive amounts of information. The real question is not whether SanDisk matters. The real question is whether today's extraordinary profits are the beginning of a long new era, or simply the peak of a very powerful cycle. And that is exactly what investors need to decide before buying the stock here. If this analysis was useful, I'd really appreciate it if you subscribe to the channel. That support goes a long way and helps keep this kind of work going. Thank you for watching.